gold continues to hit an all-time high, above $4,000 per ounce. Why is this happening? Well, calm down. Let me explain. Now, before I explain, this is not financial advice. I'm just sharing educational content about dividend investing. The content in this video is for informational purposes only and should not be considered as investment advice. For the first time in history, an asset has crossed $30 trillion in market cap. That's the total market capitalization, over $30 trillion. Gold. You can see other assets like Nvidia, $4 trillion, and Microsoft. Silver is at $3 trillion. Pay attention to silver. Even Bitcoin is currently at $2 trillion. It shows you where the world is pumping money to. Not even AI is catching up with gold. Now, this is a major driver. The global debt in the world has hit $337 trillion. Who are we owing? Who is the world owing? Let's take, for example, China. Several African countries owe China. Likewise, USA. Now, most countries are buying gold because they are scared of what might happen to the reserve currency of the world, which is the dollar. The US is so indebted that they are paying $1 trillion as interest alone. So in the world currently, people are looking for where they will have a safe haven, where if anything happens, they are sure that they are safe. And historically over the years, that has always been gold. The people in the digital space think Bitcoin might be the next gold. But for the first time, silver has crossed all that. People are still looking at silver as another form of safe haven. So in the meantime, the people who are holding gold are in profit. But is it a speculation? And is it a pointer to a potential bubble in the whole market? Because everything seems to be going up. Here's the thing. Whether you believe we're at the top or not, gold has proven itself as the ultimate inflation hedge. With gold prices surging 64% year-to-date in 2025 and central banks around the world accumulating over 500 tons in the first half of the year alone, the message is clear. Institutions are preparing for economic uncertainty. The beauty of gold ETFs is that you don't need to worry about storing physical gold, insuring it, or verifying its purity. You get exposure to gold's price movements through a simple stock purchase. And just like I always say, I won't wait until I have $1,000 before I start investing. I've developed a habit and I've been consistent with small amounts. You can start with as little as $10 through fractional shares. Today, I'm breaking down the 3 best gold ETFs you need to know about. If you want to protect your wealth against inflation and the weakening dollar, let's get straight into it. ETF 1, SPDR Gold Mini Shares Trust, ticker symbol GLDM. The first gold ETF I want to talk about is the SPDR Gold Mini Shares Trust with ticker symbol GLDM. This is my topic for beginners and cost-conscious investors. GLDM tracks the price of physical gold bullion. The fund holds actual gold bars stored in secure vaults, primarily in London, and each share represents a fractional ownership of that physical gold. As of October 2025, GLDM manages approximately $17.3 billion in assets. Now here's what makes GLDM special. It has one of the lowest expense ratios in the entire gold ETF space at just 0.10%. This means you're only paying $10 per year for every $10,000 invested. Compare that to the more famous GLD, which charges 0.40%, 4 times more expensive. Over the past year, GLDM has delivered returns of approximately 30 to 9.2%, perfectly tracking gold's incredible rally. If you invested $1,000 into GLDM 1 year ago, you'd have roughly $1,392 today. That's nearly a 40% gain while stocks have been volatile and bonds have struggled with rising rates. The share price of GLDM is also much more accessible than its bigger brother, GE. While GLD trades at around $400 per share, GLDM trades at roughly $40 per share. This makes it easier for retail investors to buy full shares or use fractional shares to build positions gradually. And remember, I'm all about consistency. Even if you can only invest $20 or $50 per month into GLDM, that adds up significantly over time. ETF 2, iShares Gold Trust, ticker symbol IAU. The second gold ETF is the iShares Gold Trust with ticker symbol IAU. This is one of the largest and oldest gold ETFs in the world, launched back in 2005 by BlackRock. IAU manages approximately $72.7 billion in assets, making it the second largest gold ETF after GLD. Like GLDM, IAU holds physical gold bullion in secure vaults, with JP Chase serving as the custodian. Each share represents roughly 0.1 ounces of gold. The expense ratio for IAU is 0.25%, which is more expensive than GLDM but still significantly cheaper than GLD. For every $10,000 invested, you're paying $25 per year in management fees. Over the past year, IAU has also delivered strong returns of approximately 37% to 38%, closely matching the spot price of gold. The fund is extremely liquid, with millions of shares trading daily, which means you can buy or sell without worrying about getting a bad price. IAU's share price trades around $72 to $73, making it more affordable than GLD but slightly more expensive than GLDM. The advantage of IAU is its massive size and liquidity. If you're planning to invest larger amounts or want the peace of mind that comes with one of the world's most established gold ETFs, IAU is an excellent choice. One thing to note about both GLDM and IAU is that they don't pay dividends. Gold itself doesn't generate income, so these ETFs simply track the price of gold. Your returns come purely from price appreciation. ETF 3 SPDR Gold Shares, ticker symbol GLD. The third gold ETF is the SPDR Gold Shares with ticker symbol GLD. This is the granddaddy of all gold ETFs, launched in 2004, and it remains the largest gold ETF in the world. GLD manages over $120 billion in assets, making it the most liquid and heavily traded gold ETF globally. Like the other two, GLD holds 100% physical gold bullion in secure vaults. The fund's gold is held with trusted custodians like JP Chase. Now, here's where GD differs. Its expense ratio is 0.40%, which is significantly higher than GLDM and IAU. For every $10,000 invested, you're paying $40 per year. That extra cost might not seem like much, but over 10 or 20 years, those fees compound and reduce your overall returns. So why would anyone choose GLD over the cheaper alternatives? Two main reasons. First, institutional investors and large funds prefer GLD because of its massive liquidity. The bid-ask spreads are incredibly tight, meaning you lose almost nothing to trading costs when buying or selling large positions. For retail investors like us, this advantage is less important. Second, GLD's share price trades at around $400 to $410, which represents roughly 1/10 the price of an ounce of gold. Some investors prefer this because it makes the math easier to track how much physical gold they own. But with fractional shares available on most platforms, this advantage has become less relevant. GLD has delivered approximately 37% to 38% returns over the past year, matching the other gold ETFs. The performance is nearly identical across all three because they're all tracking the same underlying asset, physical gold. Now, let me be clear about my own position. Gold is a defensive asset. It protects wealth, but it doesn't create new wealth. Emerging market stocks, on the other hand, offer a potential for substantial capital appreciation. My strategy is to have some gold for protection, maybe 5% of my portfolio, while allocating the majority to growth assets in emerging markets. That said, if you believe we're heading into a major economic crisis, or if you're risk averse, increasing your gold allocation to 10% or even 15% makes sense. It's all about your personal risk tolerance and financial goals. Now, my final thoughts. Gold has made history by crossing $30 trillion in market cap for the first time ever. central banks are hoarding it, investors are fleeing to safety. And with global debt at $337 trillion and the US paying $1 trillion in interest alone, the fear about the dollar's future is real. Whether we're at the top of a bubble or just the beginning of a longer gold rally, having some exposure to gold through low-cost ETFs like GLDM, IAU, or GLD makes sense as part of a diversified portfolio. Just don't put all your eggs in one basket. Balance your gold allocation with growth assets, especially in emerging markets where the real wealth creation happens. That's it for today's video. If you found this valuable, smash the like button and let me know in the comments which of these 3 gold ETFs you're considering, or if you think gold is overvalued right now. I'll see you in the next video.